Picture it. The year is 1999. A young entrepreneur with an innovative idea for an online business. The dot-com era is in full swing, and investors are throwing money at any startup that has even the slightest chance of success. You launch your website, raise millions in funding, and watch your stock price soar to the moon. You've made it big, and all because of one thing, the internet. But then suddenly the music stops. Dot-com bubble bursts, and your company goes bust. You lose everything, and you're left wondering where it all went wrong. Well, my friend, you've just experienced a phenomenon known as the greater fool theory. And guess what? You might be seeing it happen again right now in 2023. So grab a cup of coffee and let us talk about it. The Great Depression of the 1990s was a time of great economic prosperity in the United States. The unemployment rate was low, inflation was stable, and the stock market was booming. But there was one sector that was particularly hot: technology. The internet was still a relatively new phenomenon, and investors were eager to get in on the ground floor of what they saw as the next big thing. Venture capitalists were willing to invest in companies with little or no revenue based solely on the potential of the technology. And these companies were popping up everywhere. One of the most famous examples of a dot-com company was Pets.com. It was an online retailer of pet supplies that was founded in 1998. By 1999, the company was valued at over $10 billion, despite the fact that it had never turned a profit. Another example is Boo.com. It's an online fashion retailer that launched in 1998. It was backed by some of the biggest names in Silicon Valley, including Sequoia Capital, but it went bankrupt just 18 months after it launched. As more and more of these companies popped up, the media began to take notice. The Wall Street Journal began publishing a daily list of new internet companies that were going public. And by the end of 1999, there were so many companies listed on the NASDAQ stock exchange that the acronym NASDAQ became synonymous with the dot-com bubble. In hindsight, it's easy to see that the dot-com bubble was unsustainable. There were simply too many companies that were trading at ridiculous valuations. But at the time, it seemed like the party would never end. That all changed in early 2000 when the bubble finally burst. So what happened? Well, as we mentioned earlier, venture capitalists were willing to invest in companies with little or no revenue, based solely on the potential of the technology. But as the bubble continued to grow, they began to invest in companies with even less potential. In fact, they began to invest in companies that were essentially just scams. When the Federal Reserve Bank raised interest rates in 1999, it made it more expensive for these companies to borrow money, which caused many of them to go under. As these companies began to fail, investors began to panic. They started selling their stocks en masse, which caused the stock prices to plummet. The bubble had burst. Over the next few years, thousands of dot-com companies went out of business, and the NASDAQ stock index fell more than 75% from its peak. Many of the investors who had gotten involved in the bubble lost everything, and the economy fell into a recession. But you may be thinking, what does all this have to do with me? Well, my friend, we might be seeing a similar tech storm on the horizon. But before we get into that, let's take a step back and talk about what the greater fool theory actually is. The greater fool theory is a theory in finance that suggests that investors can make money by investing in something that is overpriced if they can. Find a greater fool who is willing to pay even more for it. In other words, it's the idea that you should buy high and sell higher. This theory is often used to explain the behavior of investors in a bubble market. For example, imagine that there is a stock that is trading at $100 per share. According to the greater fool theory, it doesn't really matter if the stock is overpriced or not, because if you can find someone who is willing to pay $110 per share for it, you can make a profit of $10. Of course, this theory is not without its risks. If you can't find a greater fool to sell the stock to, you could end up holding the bag when the bubble bursts. But that's a risk that many investors are willing to take. For example, in 2000, there was a company called Webvan that went public. The company was a grocery delivery service that operated in the San Francisco Bay Area. It was founded in 1996 and it went public in 1999. On the first day of trading, the stock price shot up to $100 per share. According to the greater fool theory, an investor could sell the stock for $100 per share and make a profit of $90 per share. But what if the investor couldn't find a greater fool to sell the stock to? Well, unfortunately, That's exactly what happened. Webvan's stock price plummeted to just 25 cents per share in 2001, and the company filed for bankruptcy. The investor who bought the stock at $100 per share and sold it for $10 per share lost $90 per share. Now let's talk about what's happening in 2023. In recent years, we've seen another boom in the tech industry. Many new companies have emerged, and investors are once again throwing money at them. But there are some warning signs that the bubble may be starting to burst. One of the biggest warning signs is the number of unprofitable tech companies that are still receiving funding. For example, Rivian is an electric vehicle company that was founded in 2009. It went public in 2021 and is currently valued at $21 billion. But the company has yet to turn a profit. Similarly, Robinhood is a financial services company that went public in 2021. It's currently valued at $14 billion, but is also yet to turn a profit. Another warning sign is the number of tech companies that are laying off employees. For example, Amazon has announced plans to lay off over 18,000 employees, and Meta, formerly Facebook, has announced plans to lay off over 11,000 employees. These layoffs are likely due to the fact that these companies are facing slowing growth and increasing competition. Finally, the tech industry is starting to see a slowdown in funding. For example, in 2021, startups in the U.S. raised a total of $327 billion in venture capital. But in 2022, that number fell to $268 billion. This is the first decline in VC funding since 2020. So is history about to repeat itself? Only time will tell. But it is important to remember that past performance is not indicative of future results. Just because the dot-com bubble burst in the early 2000s doesn't mean that the tech bubble will burst in 2023. However, it is important to be aware of the warning signs and to invest responsibly. What do you think? Will 2023 be the year of the tech crash, or will these companies continue to thrive? Let us know in the comments below. And if you want to learn more about the dangers of investing in bubbles, check out our video on the Tulip Mania. Thanks for watching.